Welcome back, everybody. Today we are tearing into a really fascinating explainer based on some eye-opening source material about what's known as the collateral loophole. Now, if you are a business owner and you're just itching to scale up and grab some new assets, but you're absolutely terrified of draining your bank account down to zero to do it, well, you are definitely in the right place. We're going to look at how the actual assets you're buying can essentially secure your funding for you. So our source material kicks things off with this absolute hook of a question. Imagine you could get approved for $60,000 in business funding today, like right now, even if your personal credit score is, let's be honest, absolutely tanked. For most of us, a low FICO score means the bank gives you a hard no, and that's just the end of the story, right? But as we're going to see, traditional banks are usually just staring at the complete wrong part of the equation. Okay, quick look at the roadmap for today's explainer. We're going to hit the traditional bank trap, defining the collateral loophole, mastering cash preservation, establishing your business foundation, and finally, we'll wrap up with the future credit snowball. Starting right off with Section 1, the traditional bank trap, and those lovely checklist rejections. Look at the stark contrast here. It's literally night and day. On the left side, traditional banks are just entirely checklist-driven. You know the drill. If you don't fit into their one perfect little box, it's an automatic rejection. They obsess over your personal credit history. Actually, scratch that. They'll practically hold a missed cell phone bill from 5 years ago against you forever. But over on the right, equipment lenders play a totally different game. They aren't digging through your past. They focus almost entirely on the security of the asset you're bringing to the table, and, more importantly, the future revenue that asset is going to generate for you. All right, moving to Section 2, defining the collateral loophole. So what actually qualifies? So in the financial world, this collateral loophole is officially known as equipment financing. It's basically a strategy where the actual value of the equipment serves as the collateral for your loan. And because the lender is holding onto that physical asset, their risk just totally drops off a cliff. Suddenly, they really don't care if you have a perfect 800 FICO score. Like the source points out, the equipment itself is doing all the heavy lifting for your approval. Now, I know what you're probably thinking. Equipment? I don't need a tractor, so this doesn't help me. But wait, the definition of equipment is wildly broad. We are talking commercial delivery trucks, sure, but also high-end restaurant kitchen gear, incredibly expensive medical devices, construction machinery, and get this, even high-end computer systems and software. The golden rule from our source is super simple. If your business uses it to generate revenue, there's a really good chance it fits the loophole. Moving into Section 3, mastering cash preservation. And listen, this is the ultimate advantage. Let's break this down with a real-world example from the text. Say your business desperately needs a new $60,000 truck to expand. Under the massive mistake column, you save up, you pay cash, and boom, you completely drain your business accounts. Why is that fatal? Because cash is literally the oxygen of a growing business. If you choke out your accounts for one single truck, one unexpected crisis could take your whole company down. But look at the loophole column. You put down maybe 5 to 10 grand, finance the rest. You get the exact same truck, but you fiercely protect the cash you already have. And this chart just brilliantly illustrates the math. See that tiny slice? That's just the $10,000 down payment leaving your account today. The massive chunk, the other 83%, is financed, totally secured by the truck itself. But here is the absolute magic of this. That truck goes right to work. It starts earning you money on day one. So it's essentially paying for its own financing through the brand new revenue it brings in. And this right here, this is why we care so deeply about preserving cash. It is absolutely crucial when you're scaling a small business. You have to keep what the industry calls dry powder. By financing, you successfully kept $50,000 locked safely in your bank account. Because let's be real, unpredictable expenses are just a daily fact of life for a business owner. You need liquid capital for the things you can't just easily finance, like making payroll when you hire a new team, buying seasonal inventory, or just aggressively funding marketing to crush your competitors. Preserving your cash gives you the agility to actually survive and scale, instead of just owning a hunk of metal outright while the rest of your business starves. Okay, Section 4, establishing your business foundation. Because you have to look the part. Listen, even though the equipment is the star of the show here, lenders still need to see a legitimate operation. They don't want to lend to a hobbyist. But the execution checklist is really straightforward. First, formally register your LLC or corporation. Second, get an EIN from the IRS. Third, and I cannot stress this enough, this is non-negotiable, open a dedicated business bank account. Keep your finances separate. And finally, secure a professional business address. And here is why we care so much about that setup. The source drops this huge quote. Some equipment lenders won't even check your personal credit at all if your business financials and the asset value are strong enough. Just think about that for a second. If you structure the business correctly and the asset you're buying has strong value, you might just completely bypass that personal credit check you've been so stressed about. No way, right? But it's true.
Which brings us to Section 5, the future credit snowball. This is where we play the long game.
So here's the strategic nuance that most people totally miss about this. On day one, you use the loophole to get the equipment. Boom. But over the next 12 months, every single on-time payment you make is actively being reported, building up this rock-solid business credit profile. You use the asset to get the funding, and then you use the funding to build your track record. It's like a domino effect. By year 2, that profile snowballs, and suddenly you're unlocking massive 0% interest lines of credit from the exact same big banks that used to reject you.
Now, just to report impartially on what the author suggests, if your credit is currently dragging you down, they know some folks might feel like their score is too far gone, so they outline a couple of tools. First is something they call Credit Rehab Pro, which is a DIY tool that scans reports and spits out automated dispute letters. And second, they highlight a free credit bootcamp that apparently teaches you the exact application sequences and points out specific lenders who are currently approving these asset-backed deals. So we're going to end on this incredibly provocative question directly from the source. Will you let a 3-digit number hold your business back? You know, the traditional banking system really wants you to believe that your FICO score dictates your entire potential. But once you understand asset-based lending, build that solid foundation, and fiercely protect your working cash, you can just walk right past the gatekeepers. Stop begging banks for a chance and start using your assets to your advantage. Thanks so much for hanging out with me for this explainer, and keep learning.